Good afternoon, this is Alan Rosenfield. I'm Managing Director at Harmony Asset Management, and this is our Q4 2019 review and a look into 2020. In summary, last year was a good year. If you invested in the US in either stocks or bonds, you made money. This next year, we don't think will be as strong, but right now it doesn't look too bad. Stay tuned for the details. So let's look at 2019. In the US, the stock markets, regardless of which index you look at, were up nicely, all over 20%. The bond markets were up all over 6%, and that's the treasury market. Corporate markets were up even more. If you look at this chart, this actually shows the US Treasury yield curve at 3 time periods. Each color is a different time period. December 2018, September 2019, and December 31st, 2019. What you see is the yields started dropping. They came back a little bit, but they're still much lower than they were. Not a bad thing. When we look at fundamentals, though, we see slightly different information. So first off, let's look at revenues, and we're speaking specifically at the S&P 500 level. Revenue growth actually peaked in June 2018, and it's been slowing ever since. Now, it's still positive, but instead of 10+% growth, we're down near 5% growth. That's something to watch. Net income pre-tax, actually, the net income itself has slowed. So we peaked in September of 2018, and year over year, 18 to 19 through the third quarter, net income's flat. Again, something to watch. Other things we want to watch, PE ratios, extremely high, almost as high as they've ever been in 90 years. Total debt. S&P debt is back up to levels where it was in 2008 prior to the crash. Not suggesting we're getting a crash, simply saying debt levels are getting very high. So far, margins are holding steady, but that's something we're going to want to look forward to. Looking ahead to 2020, there's some very positive tailwinds, and there's some challenges, some headwinds that we'll need to watch. So let's look through them. Positives. 1, any settlement of the trade deal. Talk is that they'll sign the phase 1 with China in the middle of January. We've already got an agreement with Mexico, and maybe we'll get something soon with Europe. Anything positive out of that can add, according to economists, close to 0.5 to 1% to GDP this year. That's certainly a positive. Second thing is, notice that this is an election year, and Congress just passed a $1.4 trillion, yeah, that's a T, that's a lot of zeros, spending bill. $1.4 trillion is going to get into the economy because they're going to spread it around during the election year. That's a very positive point. The last piece of the puzzle for the positives is that since September, the Federal Reserve has been pumping money back into the economy via repos. Now, without getting into a lot of details, repos are a short-term funding mechanism for banks and corporations. And in the third quarter, we started getting some liquidity issues, so the Fed started pumping. Look at this chart. Notice the highlighted areas. The top is the Fed's balance sheet. All of a sudden, near the end of September, it skyrockets, almost $400 billion. At the same time, the lower chart's the S&P 500. Notice in that shaded area, about the same time, stock market takes off. There are a number of reasons that could explain why this is happening, but the bottom line to understand is the Fed's producing a form of QE, and it's getting into the stock market. As long as they're doing that, that's a positive. If they turn it off, which I don't expect they're going to do anytime soon, that could become a negative. So it's something we're going to watch. Some of the challenges that we need to look at this year. One that we spoke about already was corporate and government debt. If you look at this chart, this is corporate debt, S&P 500. Notice how it's been growing. Remember that we are now back up to debt levels in 2008. Yet this debt was not used to create future revenues. It was to pay dividends and to buy back shares. So if there's a recession, then all of a sudden you're going to have all this debt and it's not going to generate revenue. And that could be an issue. So we're going to watch that. We've already noted that earnings are slowing. We have to watch that. Wages are rising. Wages grew faster in 2019 than at any time since 2013. Plus, we're starting to see oil prices up a little bit. So we need to watch and see if margins start to get impacted at all. Finally, we have to watch interest rates. Look at this chart again. This was the chart earlier where we were looking at the different yield curves. But now we're looking at the spreads in the yield curves, the difference between the 3-month and the 10-year treasuries. Notice how they've been widening. They've been going up. Normally, when you start getting nervous about a stock market, those don't widen. They actually come down. If those continue to widen, that means companies borrowing money are going to be paying more. All of this adds to the fact that at a time when their earnings aren't growing as fast, if their debt levels, or the interest they're paying on those debt levels are rising, that can add to a squeeze. None of this indicates that we're about to have a recession. They indicate issues that we want to watch, which could suggest a recession later on if other things happen as well. So, bottom line, we don't think this year will be as strong as last year, but it may not be half bad. The difference is there are enough concerns that we want to continue to be defensive, because the one thing we don't know is if there's a black swan event coming our way. Remember, a black swan event is something coming out of left field that nobody saw coming. So being a little bit more protected is a good way to be. Thank you for listening, and we'll be speaking again with you soon.